Peter and I are tax attorneys, and before the pandemic, we were practicing tax controversy, which is audits, payroll tax liabilities, sales tax liabilities, working with companies and getting them to work through their tax problems, essentially. And then when the pandemic began, we realized that we needed to work with these companies to get them PPP, ERC, EIDL, all of the things. And so we worked with that, and it's been a really natural progression for us to start working with the National Restaurant Association, the Louisiana Restaurant Association. We're really happy to partner with such a great group in helping people kind of work through their employee retention credit, analysis, but also to make sure that people are claiming the right amount. So we talk about it as kind of like a Goldilocks thing. So you don't want to underclaim, but you also don't want to overclaim. So we are going to kind of go through the process of what we think you should be thoughtful about when you think about an audit. Make sure that your company is protected in case the IRS does ask you some questions about your employee retention credit filing.
Oh boy.
What are you doing?
I didn't do that. All right, so why we're here and what we're doing is, look, the IRS is starting to do these audits. They've gone through trainings. There are revenue agents who are doing this stuff. For the long time, the IRS was very quiet about ERC after rolling it out. That changed last October, where they finally issued this bulletin saying, look, some third parties are taking improper positions related to taxpayer eligibility for and computation of the credit. And why that matters is there's going to be scrutiny, and the consequence of improper claims is repaying the tax, penalties, interest, potential for whipsaw on an income tax return. The IRS continued that notice and added ERC to their Dirty Dozen list. Dirty Dozen list is an annual PR campaign to highlight the worst of the worst frauds, okay? And then, you've gotten the commissioner talking about increased scrutiny. The point of this is the IRS made this, for better or worse, really easy to do incorrectly and really hard to do correctly. And so what we want to do in this talk is go through and help you understand what are the basics, but then also what are the sort of red flags? What are the things that you ought to be concerned about? What are the things that you ought to go back and talk to whoever it was that did your claims in the first place? Go back and ask them, why am I eligible? Show me governmental orders, show me computations, let me see the work papers, and we'll go through those types of things. Give it back to you.
Can you guys hear us okay? All right. Usually people can hear me just fine, but I like to double check. All right, so what is it and what are we talking about? The employee retention credit was in the CARES Act, the initial legislation that went through when COVID began. But at the time, you couldn't use PPP and ERC together. And then that all changed in December of 2020 when you could use both programs. Just really quickly, so for 2020, the credit is 50% of up to $10,000 in qualified wages, and for 2021, it's 70% of up to $10,000 in qualified wages per employee per quarter. So what is it? To be eligible for the credit, you need to be carrying on a trade or business, right? That makes sense. During the calendar quarter that you're claiming, and the gross receipt eligibility method is pretty simple and pretty straightforward. I'm sure you all know that pretty well. But for 2020, your gross revenue had to go down 50% quarter over quarter. For 2021, it had to go down 20% quarter over quarter and compared to 2019. Now, there are alternative quarter elections, so just make sure that you're looking at those properly. Your 2020 eligibility will continue until the quarter after the quarter of which you hit a 20% decline. And for 2021, your eligibility, if you drop down 20% in one quarter, you're automatically eligible for the next quarter. Your gross receipt decline does not have to be for any reason about COVID. It could be for any reason at all. We have clients who lost contracts, closed locations, and they are now eligible because of the gross receipt decline. So that one is pretty straightforward, and if an IRS agent asks you for questions, you can show them your profit and loss statements and your bank statements, and all should be well, assuming that you did the math right. Where people are going to have trouble is the second way of qualifying, right? The full or partial suspension test. So you have to have an operation of a trade or business is fully or partially suspended during the calendar quarter due to orders from an appropriate governmental authority, and that's federal, state, local. Some people try to use foreign orders when they're trying to make a supply chain claim or something like that. That is not okay. Has to be federal, state, or local. Limiting commerce, travel, or group meetings due to the coronavirus disease 2019. So it has to be because of COVID. That is why you were suspended. So we tell people to think about it like eminent domain, where the government came in and they took something from you. They built a road in your backyard. So they took your ability to operate your business the way you did in 2019 away from you by not letting you have people in your dining rooms, by mandating 6-foot social distancing, by mandating certain sanitation orders. Because the government took something, you're then eligible for payment of a credit or to reward you for that process. If people just didn't come in, it's not because of a government order, but people were scared or people didn't want to use your services. That's not the same thing. And so you have to make sure that you're actually restricted by the government order and be able to show that it was more than a nominal portion if you're fully suspended. And then you're looking at 2019 revenue. So nominal is 10%. So if your indoor dining, for example, was more than 10% of your revenue in 2019, you can be an eligible employer. If something is not fully suspended, but now we're talking about a partial modification, so you're open, you're doing 6-foot social distancing, 50% capacity, now we're in current conditions. So let's say it's June of 2020. To determine whether or not those restrictions had more than a nominal effect on the business ability to operate, now you have to look at your DoorDash. You have to look at your drive-through. You have to look at your in-person dining that was still able and see, okay, these restrictions still had more than a nominal effect on our ability to provide goods and services. And that's a tough test. If somebody's telling you you're automatically eligible for anything, you need to understand that that's incorrect. You actually need to look at each company's facts and circumstances and see what applies. Because some companies aren't going to be eligible based on all of that.
So basically, this slide is the law. This is the CARES Act and as it's been amended and reintroduced. This slide is what the Treasury has come back behind in their sub-regulatory guidance, but guidance nonetheless, and said, this is what we think and how this works. This is where it gets really, really hard. And it gets really, really hard too, because now the government is coming back behind in an audit and saying, okay, quantify this stuff. How do you quantify your ability to provide goods and services in the normal course? What are the metrics that you would put in front of a revenue agent? How are you going to say that this had a more than nominal effect? It's even a little bit more straightforward when you're dealing with the nominal portion analysis, when something is totally closed. But when something's not totally closed and you just have these conditions of reopening a physical space, boy, that's really hard. And that's what they're doing in these audits, is coming back behind. I talked to a long-term care facility, and the government acknowledged that there were orders that limited it, and they said, okay, quantify it. And this long-term care facility said, all right, I'm going to go back and look historically at my census data for butts and beds pre-pandemic and during the pandemic. And they were able to quantify that it went down by 22%. And the government said, okay, that's interesting, but you haven't demonstrated to me that it was because of the governmental order. So now it's not because Billy didn't want to send mom to a nursing home during a global pandemic. You've got to pull it back to the government order. And that's where this stuff is really getting difficult. What we want to do on these next couple of slides, and I take odd and you take even. This is just what we've gone through and identified as some of the more concerning claims and things where there may be some issues. So the first one is supply chain claims. Certainly there is support in the guidance to say that someone could be eligible if they were unable to obtain critical supplies and materials from vendors. But what some of these ERC mills have done is to say general supply chain disruptions generate eligibility. And like I said, in the case of the long-term care facility, you have to pull it back to governmental orders. It can't just be bad government policy that is encouraging people to stay on unemployment or something like that, where you can't get labor and it's messed up the supply chain, or it's shipping containers stuck in China. These are, American governmental orders that you've got to pull it back to. IRS recently came out with a generic legal advice memorandum they called a GLAM 2-3 weeks ago, and set up 5 different scenarios where supply chain could be an issue. And in each scenario, the government said, no, that's not enough to generate eligibility, and not only is a taxpayer going to be required to establish that they had a more than nominal portion closed or more than nominal effect on their trade or business operations, but they're also going to have to prove that their supplier did. So now you're being asked to prove something that's even once removed. So if the theory of the case that you're using is a supply chain, come back behind and make sure that you can prove it.
So if your theory of your case is supply chain, look back through. I would say that's a pretty problematic position at this point, unless you have very specific information for your suppliers. That is something to just be very wary of at this point. There was a Ways and Means hearing the other day in Congress where they were talking about doing a voluntary disclosure program for people who made supply chain arguments, because they decided to wait 2 years to come out with this GLAM, just not really taxpayer friendly. So the other is just PPP and RRF offsets. Just be careful, make sure you're not double dipping. RRF, you actually can double dip for the first 2 quarters of 2021, but you can't for the second 2 quarters of 2021, so make sure that you're paying attention to that. What we do is we have a work paper that we give everyone so they can see exactly what like the PPP wages were versus the non. If the person who prepared these claims for you hasn't done that, just ask like how they calculated it and how they backed out the PPP. I would get the information now while everyone is still operating and this is still happening, versus waiting for the company to kind of go out of business and not have the paperwork that you need. We're going to talk about other things to get from these people also, but that's just one.
Number 3, analysis of multi-jurisdictional operations. There's just some very strange program rules about what happens if you have locations in multiple jurisdictions, different counties, different states. Orders that operated on one location may not have operated in the same way on another location. Making sure that that analysis is done correctly is important, because it can have impacts on how the credit is ultimately computed, and that is true based on a single employer with multiple locations or multiple locations within an aggregated group, which rolls into the next idea of control groups.
So the rule is, if part of the notice says if you have a restaurant in multiple places, then you get to take the longest jurisdiction of that group. But you still have to show a nominal effect. And so it's a 3-part analysis, and people are jumping to conclusions by using the notice to expand eligibility. And what you just need to do is still say, okay, if I've got 15 restaurants in Houston and I've got 1 restaurant in New York, can you actually take the New York restrictions? Is it still more than a nominal effect because New York went further than Houston? That's the conversation that you need to be having with people, and trying to understand, okay, my claim might be good through this date, it might be a little less good, might be a little more questionable, in this chunk of time, and that's just something to think about. But yeah, misunderstanding of control groups, we've talked to so many people who own, I don't know, restaurant folks, you guys own so many things. But we've talked to people who own 50 restaurants, 100 restaurants, but they all have different LLCs. And they're like, well, they're all different companies. They're not according to this. You have to look at, see how things actually roll up and see whether you need to take it in consideration as a whole. So then you're looking at gross receipts altogether, you're looking at employee count altogether, and there's a lot of things that could get messed up when you bring things together versus when they're pulled apart. And vice versa. Sometimes someone looks at the whole group and there's actual different ownership structures that you can pull apart that will be more beneficial.
And even, I mean, control groups, there's also an idea of affiliated service groups. But then number 5, disregard of family attribution rules. If you've got spouses working in the same business, you know, they're going to be attributed each other's ownership. You can have situations where spouses own 2 separate companies singly, and they don't, you know, participate in each other's businesses, but they have a minor child who's under age 21, and now that minor child is going to be treated as owning both of those businesses, and now you have a controlled group when something really shouldn't seem that way, but that's how it works in this place. So, you know, understanding not only who is owning it, but the relationship between the people is very relevant with spouses, parents, and children.
Q3 2021 claims, be very careful if you're making a Q3 claim. One, the audit statute is longer, which we didn't say anything about statute of limitations, but the assessment statute right now for 2020 claims is April 15th of 2024. For Q1 and Q2 2021 claims, it's April 15th of 2025. And then for Q3 and Q4, it's April 15th of 2027. So one, the government has a longer time to audit you and to issue an assessment. 2, with few exceptions, most of the country was back open in Q3 of 2021. So I know there's like the island of Samoa, like there's certain places that were still locked down. But for the most part, most of the United States was back open at that time. And if you're not making a gross receipts claim, you should be very careful about going all the way through that Q3 eligibility. Make sure you understand what you're claiming on that return. You know, each of these 941s, you're making a determination that you're an eligible employer for that period of time. So Q2 of 2020, you're making a determination, same as Q3 of 2021. It can be different methods of eligibility, but you have to make sure that you understand why you're making that claim.
So for number 5, I said you needed to know who owned it and what their relationships were, but now in number 7, I'm looking at, first of all, majority owners' wages are not considered qualified wages for purposes of the credit. So a majority owner is not 50-50, but 50% plus 1. But now I also need to know who's working in the business, and family relationships matter, and step relationship matter, and in-law relationships matter, and those individuals who are related to majority owners' wages are now not qualified wages. So just to say, the devil continues to be in the detail, and you've got to work through these things and make sure that, you know, folks that were computing this for you realized what the family relationships were.
Do you have any idea what time it is? Do you know the time?
Yeah, we have 5 minutes.
We have 5 minutes? Oh,
Yeah.
All right. We're right on schedule. Awesome. Full-time employee analysis. So the full-time employee analysis is actually calculated in 2019. And you're checking to see how many employees you had each month that hit 130 hours, and then take an average. If you had more than 100 full-time employees in 2019, then the only wages that are qualified in 2020 are when you paid people not to work. For 2021, that 2019 number is 500. So as long as you have under 500 people in 2021, then all wages are qualified. If you're over, then you are looking at people that you paid not to work or perform services. This gets really tricky when you start rolling all these companies together, because a lot of people are going to have, their wages will be disqualified because of that full-time employee count. And I know people are kind of crossing their fingers because there's a lot of different EINs and LLCs and things like that, but just beware that that's an issue that people should be paying attention to.
Right, so if you messed up number 4, there's a decent shot you messed up number 8. 9 and 10 I'll do together. The nominal effect analysis is when this really, really gets hard, and frankly when it gets to be about as clear as mud in a lot of circumstances, because you're allowed to operate, but there are some things that are operating, some orders that are still operating on the business. Typically for restaurants, it's something like a capacity limitation on indoor dining, mixed with enforced social distancing for both staff and customers, right? But now, and Rebecca mentioned this previously, but you've got to consider how that government order still affected everything. So if drive-through sales went up exponentially and the community rallied around you and carryout was up, or DoorDash came online, or whatever one of these delivery services came online, you're being asked to evaluate the relative worth of the indoor dining operations in compared to all of it. And that's going to be really hard because you're going to be asked to quantify something that you didn't know that you should have been tracking, because you didn't know that you could ever be eligible for this credit because during the pandemic you weren't. And it didn't really start to open up until December of 2020, and even then March and November was additional legislation in 2021. So all of this is to say is go back and ask why your preparer said you were eligible. And this next slide is the government from the start telegraphed as to what they were going to ask for. It's question and answer 70 in Notice 2021-20. If you qualify based on a full or partial suspension of trade or business operations, get the government orders. These things end up being hundreds, if not thousands of pages long. You're going to have to show a tracing from the beginning of eligibility till the end. These are very specific dates and times, start to finish. These government orders are starting to come down as new politicians come into office. They get new websites. Just be aware of that. We use the Wayback Machine in our practice way more than we ever thought we would. If you have a decline in gross receipts, make sure you can show it. Typically that's quarterly P&Ls. You're looking at dollars in the door net of allowances and refunds. Records of qualified wages may be the easiest thing. It's just payroll data, but if you're a large employer, you're going to have to show evidence that you were paying someone not to work. What is that? You're probably showing timesheets or schedules. Documentation of health plan expenses. You can use health plan expenses as wages. Documentation of aggregate group employer determination. They are absolutely asking for this in these audits when they talk through full-time employee counts, and it's sort of a gotcha moment to make sure you're grabbing everybody. Form 7200 wasn't really a thing. It's included in QA 70. Copies of the tax returns, and keep them for at least 5 years. There are rumbles. The Biden administration asked Congress to increase the statute of limitations for all the claims so that it would be to 2026 or 2027.
That's true. I said the audit statute date. That could change, but for now, that's where we are.
Yeah. So, I mean, Congress can retroactively change this to go back and give the government more time. So just be aware of that. I think this might be the last slide, so we're happy to answer any questions if anybody has any.
Yeah.
Wait for the mic.
Percent of audits? No, I don't think they will, because small.
So most audits that occur, when you think of the IRS auditing, they're income tax audits. So this is employment tax. It's a very specialized auditor to begin with. There are practitioners who go their entire careers having never done an employment tax audit. That doesn't mean that the government can't shift people around and try to get more resources here.
And that's what they say they're going to do. They're trying to train people. They're trying to put more people into this space.
But these employment
2020 is fast approaching. So it may be that they don't care that much about 2020 and they're just going to move on to 2021. It's a lot more dollars.
But because these are employment tax auditors, they're auditing other things too. They're looking at reasonable comp and C Corps and S Corps. They're looking at worker classification issues. I mean, that's what they're trained to do. So then they added on ERC.
How much of a decline in revenue? Is there a certain percentage in decline in revenue?
So that's just if you have gross receipt decline. If you're operating based on restrictions, you don't need that information. So, but if so, if you're looking at gross receipt decline, it's 50% for 2020 and 20% for 2021.
And each of these quarters can have their own theory of eligibility. So maybe in Q2 of 2020, when the world sort of shut down, you do generate something like that. But then, come Q1, when, Q1 of 21, stuff's getting a little bit better, maybe you don't have those declines. So. Correct.
Right, all compared to
2019 is your reference
2019.
period.
But the main reason we wanted to talk about these things is because we know there is I don't know how many text messages you got today just on this stuff, right? Like you guys are getting hammered. And a lot of it is by people who aren't, frankly, credible to give advice in this space. They were carpenters 5 days ago. They started 123 ERC and they will not be around anymore after a little while. Like there's just a lot of junk in the space that I think confuses people. Like people will call me and they're like, Rebecca, I'm already pre-approved for the credit, but I'd rather go with a tax attorney than go with my company. And I'm like, so you're not pre-approved for the credit. Like no one is. That's not a thing. It's not MasterCard. Like you have to actually go through a theory of eligibility. We can determine what our theory of eligibility is. The IRS may disagree with us. Like this is not something where it's not like PPP, right? Where you guys filed an application and the bank blessed it and then you got money and then you got your forgiveness application. Like this is filing a tax return. The returns are going to process. You're going to get, some cases, millions of dollars, and people are going to say, oh, I got millions of dollars. They approved my claim. And that is not the case. So we give all this information in a packet with a legal opinion letter, legal memorandum when we do our claims, but it doesn't go to the IRS. It goes to our client. The IRS gets a 3-page form for each quarter. There's nothing on there that says why you claimed the credit, what your employee count was in 2019, what you're doing. There's no information for somebody to actually decide whether or not your claim is accurate. And so that's something that people just misunderstand all the time, in that they think that when they get their money, they're safe and everything is good, and that's just not the case. Do you have any other questions? I have a little thing I usually say at the end. So Peter and I have spent a really long time learning all this stuff and arguing about it and disagreeing about it, and this is just kind of how we spend our day, coming down to Louisiana, talk to you folks. We had a seminar the other day with 1,000 CPAs on it, our competition, because we actually care that it's done properly and want to help people do it the right way, and so training them how to do it. But we're basically like Def Leppard in 1987, I know you can tell, and we are never going to be in the space again. We learned this area of law that is going to go away. Whether it's in 2025 or 2027 or whatever, it's not going to be around forever. And so while we're here, we're happy to answer questions. You filed with other people, that's fine. We might be able to still help you. You can ask us what more to prepare your claim, or you might have a question about how you're filing or something like that. We're really happy to have these conversations and discuss your options with you and try to help in any way. So don't feel like you're wasting our time. You're not. This is just truly what we do all the time. So we're happy to do more of it.